Palantir stock, you got to be flipping my flapjacks. New multi-year highs on this one here today. Absolutely extraordinary. Congratulations to all Palantir shareholders out there. I hope you're having a whole lot of fun. Palantir is now my fourth best performing stock in the public count on a percentage basis. 287% up now at this point in time, only being beat out by Meta's 326%, Tesla's 689%, and Elf's 1,400% there. In this video, right off the top, we're going to talk Palantir. We're going to talk a few other subjects in this video as well, but Palantir is going to be the main focus at the beginning here. We're going to talk about where does the stock go from here. A lot of people are looking at this baby. It's 34 bucks now. Where does it go from here? Second thing we're going to discuss, the issue with not buying Palantir stock right now, and also the issue with buying Palantir stock, because I think a lot of people are in a weird situation now where they're like, do I buy this stock? There's so much excitement around it. There seems to be a lot of FOMO. Other people are wondering, maybe I don't buy this stock, but then you're trying to judge off of short-term stock price moves, right? It's a weird situation. So we'll talk exactly about how to handle that, because I think it's a very important subject. So we'll talk about Palantir. Then we're going to talk Elf Beauty. Stock down about another 7 percentage points here today. What's the deal with this stock? The numbers have been nothing but unbelievably great. Yet the stock just goes lower and lower and lower. It's down now 19% year to date, which is unbelievable when you think about how good the numbers have been this year, how big the beats have been. For the stock to be down 19%, people are like, what's going on? We'll explain that. We'll talk about if this stock is a buy now. Monster and Celsius having some big outsized upward moves here. We'll talk about is the bottom in regards to Monster and Celsius stock, these energy drink companies. Nike showing more weakness. Stock's obviously been incredibly weak. Or is this stock going to head right back down to that $72 range? We'll speak about that in this video here today. And the last subject we'll discuss is Apple. Apple. Did I walk away feeling excited? I watched that entire event live. Did I feel excited walking away from that as an Apple customer, right? And I'll kind of share my opinions and perspectives there. Need one thing from you guys before we start this video. Are you subscribed to this channel? If you're not subscribed, hit that subscribe button. It's absolutely free to do so. Additionally, you know what else is free? My brand new workshop I created for you guys. I recorded this just a few days ago. It goes all into, because we're only a few weeks now away from the fourth quarter of the year. So everybody's kind of thinking about like, how do you start to position your portfolio? What are the type of stocks you want to buy for 2025? So in this video, I describe and talk about the type of stocks you want to buy for 2025, how you want to run your portfolio, those sorts of things. So to get free access to that, pin comment down there. We can send it over via email or via text, however you want to receive that. It's going to be very valuable to you. If you want to pause the video, go grab that now. You can. It's free to do so. So you definitely want to grab that. Okay. Palantir. It doesn't bring any tears to my eye. Let's talk about where the stock's going from here and the issue with buying or not buying the stock. First, extremely important. Everybody understands this. Important. Listen, here's the deal. A lot of people saw the move here today, and they think that is because Palantir got into the S&P 500. So they're of the assumption that people are basically being forced to buy Palantir stock because it's in the S&P 500 now. No, that's incorrect. Here's the deal, okay? Palantir doesn't actually get into the S&P 500 for real until about 2 weeks from now, okay? September 23rd of 2024. So as of right now, Palantir is not technically in the S&P 500. But what happens many times is people, because they know Palantir is about to get into the S&P 500, they buy it ahead of time, knowing there's likely a probability that, well, there's a guaranteed probability essentially, S&P 500 index funds are going to be forced to buy Palantir shares. And we're talking a lot of Palantir shares. And so that starts 2 weeks from now. So what people do is they buy the stock before that, assuming, right, that everybody's going to have to buy the stock, which is true, right? If you run in any sort of index fund in relation to S&P 500 and you got some sort of weighting in an ETF or something toward S&P 500, you're going to be forced to buy Palantir stock here starting in 2 weeks. And then that's going to be an accumulation phase that could last a week, several weeks, a month, right? And several months even. And so it's usually a very good thing for stock. Now, I put this out inside the private group. I said, just in case anyone's not aware, Palantir goes into the S&P 500 in 2 weeks. They're not technically in. The stock is going up right now because people believe it will go up a bunch more when it actually gets in S&P 500, right? They're buying in anticipation. They're hoping they can buy right now for $32, $33, $34 a share and then sell it 3 to 4 weeks from now for $37, to $40, right? A swing, which, there's a lot of people in the market that love to swing trade, do these sorts of things. Sometimes it works out really well, right? Sometimes it doesn't work out so well. That's trading for you at the end of the day. But that's what people are essentially doing here. And can I blame them for doing that? Not really. I can understand why a lot of people do it. They think it's an arbitrage. There's probably going to be a lot of people that make money on this swing. But you got to understand, this is going to create for outsized moves on the stock. And when I say outsized moves, it can cause the stock to go up way more than it probably should in the short term, right? Which can then cause a much bigger downfall of the stock when the momentum stops going in one direction and goes the other way, right? And that's where things can get ugly fast. Now, it's also very important, everybody that owns Palantir stock or is thinking about owning this stock, you've got to understand this. Palantir's market cap now at this point in time is a little under $80 billion. Now, if the stock keeps going up before this S&P 500 inclusion, which is a real potential, right? Here's the deal. It's going to go in at even a bigger market cap. So let's say Palantir goes up a bunch more. It might end up going in, when it actually is in the S&P 500, it might go in at a $90 billion or $100 billion market cap, right? And keep in mind, this is as of right now's market cap, this is around 2x the average S&P 500 market cap. Around 2x the average one, right? So you got to understand there's an epic buy coming here in terms of how much money is going to be flushed into Palantir. Like, it's going to be an epic buy when these folks are forced to buy this stock, okay? If you look at the call options here today, have you guys seen call options in regards to Palantir? These ones are the ones expiring September 27, 2024. They went insane. Check this out, right? $32 strikes were up 209% today. $33 strikes up 254% today. $34 strikes up 300%. $35 strikes up 302%. Why are all these people all of a sudden loading up on Palantir call options today and gladly willing to pay 200 and 300% premiums? And these expire just in 3 weeks from now, right? Less than 3 weeks from now. The reason people are doing this is because they believe there's going to be continued huge buying pressure on this stock, right? That buying pressure keeps coming in up until the S&P 500 inclusion. And then after the inclusion happens, there's going to be the forced buying from the index funds, right? The ETF buyers and all those sorts of folks. And so it's going to send the stock up even higher, right? And so you get the hype buy-in, the anticipation buy-in, and then you get the real buy-in from the other big money. That's why the people are willing to pay these huge premiums. Because you look at even like, let's say the stock's trading at $34.57 when I took this screenshot, right? So you may be looking at $35 strikes. You're going to pay $1.41 for those. But somebody may look at this and they might say, listen, Palantir is going to be $40, if not above $40 on 9/27. So if you believe Palantir is going to be $40 less than 3 weeks from now, right? And you can get that at $141 right now. Well, you got to understand, you could still make like a 3x on that, right? Because by the time it's all said and done, if you believe the stock's going to be like $40, I mean, you're going to probably command $5. And if you sell it a little beforehand, right, you might command over $5 in premium for that. So somebody, although they're paying crazy premium versus what they just would have paid very recently, somebody might look at this and say 141 is a smoking deal. I'm going to 2x or 3x my money in the next 2 to 3 weeks on this one. That's why people are willing to pay these crazy premiums. Do I get involved in this? No. I'm not saying people aren't going to make money, because I bet you there's going to be some people that make some big money here. But I don't want to play these short-term games. At the end of the day, you get one of these games right, you get two of them right, and you keep chasing that thrill, and then you're no longer investing. You start just becoming a trader. You start to try to get in and out of stocks, and we know it always ends ugly, right? Next thing you know, you're starting to make gambling decisions. I think the stock price is going to move, and no longer are you focused on investing, right? And we just know this always ends poorly. But I understand why people do it. The allure there is pretty exciting, right? So that's why people do it, right? Now, here's the bad in regards to Palantir. We've got to speak about the bad, because there is bad that comes with this. You've got to understand this. Here's the deal. Looking at 1000xstocks.com, obviously the valuation's gone crazy, right? As the stock's gone up higher and higher. Forward P's extremely elevated, trailing 12-month P's extremely elevated, 2-year forward P's extremely elevated. Now, one, Palantir has a sort of business model, very sticky, SaaS type company, right? And so they're always going to command big multiples. The company also grows their revenue and their profitability much more immensely than an average stock in the market. So they're always going to trade at, I mean, honestly, for Palantir for the next 10 years, should trade at big multiple expansions versus the average stock in the market. Just keep that in mind. But at some point in time, you start to reach really high numbers that you're like, oh man, I'm having trouble justifying this anymore. This is a bad that comes along with a stock price that keeps going up. You got to understand, if a stock goes up a ton, it is factually, not debatable, is factually pulling gains from the future. If the stock market goes up a bunch, it is factually pulling gains from the future, right? Things can only go up so high. So if something goes, an asset appreciate a lot, right, you're going to pull some gains from the future, which could have your particular asset then stagnate or go down for many years coming off of that, right? So you're taking a portion of future gains away. Doesn't mean you're taking all gains away, but you're taking a portion of those future gains away the more a stock goes up or the more the stock market goes up, right? And it's just facts. It's just mathematics, right? Let me give you an example. Let's say tomorrow, the SP 500 right now is around, the Dow Jones is around 40,000 right now, right? Let's say tomorrow the Dow goes to 80,000. Completely unrealistic, but let's just say that happened. I mean, that'd be very exciting. We'd all make so much money. It'd be ridiculous. We'd all be celebrating. But the issue is the Dow would then stagnate or go down for probably the next 5 to 10 years. Not the next 5 to 10 days, weeks, or months. I'm talking it would stagnate for the next 5 to 10 years because we would have pulled 5 to 10 years of gains ahead. And that would be not ideal, right? And so you just got to understand this. And this happens with stocks all the time. Tesla's a good example of this. Late 2021, Tesla stock price was $400+, right? It pulled gains, years of gains ahead, right? And I talked about that back then as a Tesla shareholder, and I kind of warned people. I'm like, the valuation got so ridiculous in regards to Tesla that Tesla was set up to be a stock that was going to either downtrend or stagnate for years, for several years to go in the future. And I told a lot of people that, and they're like, no. I'm like, listen, it's going to either stagnate or go down for years. That's exactly what we saw play out, right? And obviously, I took the majority of my profits in regards to Tesla, and I hold still a good amount of shares, but it's not what I used to hold in regards to that stock because it was a horrible setup. It was setting up for years, not months, years of underperformance, right? Now, the stock's down about 50% since that time frame. Keep in mind, the reason it's gone down so much isn't just because it pulled those gains ahead. It's also because the business model stopped producing those sort of growth rates, which caused the stock to also go down. But even if the growth rates were still great, let's say they hadn't faced as much problems in regards to the growth rates, Tesla would still be a stagnant stock today. It might be around that $400 level, but $400 is what the stock was in late 2021. So even if they had kept putting up really impressive growth rates, the stock was, no matter what, Tesla was destined to be a stagnant or downtrending stock for years to go, right? And obviously that's happened, and I played put options here and there on Tesla and done pretty well on those over time, right? Amazon, another really good example. This stock pulled years of gains ahead. Years, right? 2020, stock was around the same price as it is today. That was over 4 years ago. Over 4 years ago in Amazon stock. What does it have to show for it? Nothing. The reason was there was so much hype and excitement. Oh, Amazon. Oh my gosh. Everybody's forced to be home. Everybody's ordering all this stuff on Amazon, right? AWS growth. Oh, stimulus checks, stimulus money coming, more money's coming to Amazon, and all that played out. But the issue was the stock price had priced in years of future gains. And so Amazon set itself up in a really bad position. Now, if you were buying Amazon stock like I was in 2022, 2023, you got in at a great price there, right? But these folks that were buying back in, first half, second half 2020, they got screwed. Those people are looking and they're like, man, I didn't even make any money on these staying stock for all these years, right? So you got to understand this is a game that's played out there. And the risk with a stock like Palantir is if it continues to go too high, too fast, it's going to end up being a situation where the stock could stagnate for years potentially to go in the future, right? Now, here's what I said in regards, because I don't know if you guys follow me on X or not, but I post, a decent amount of stuff on X, right? And I said, Palantir, congrats to all bulls, what a ride. Here's my thoughts on where the stock goes from here. And I said, Ellis Karp and the team will need to continue. So first off, short term, the stock's going up. You're going to have more hype and excitement, people buying into the stock, and you're going to have the SP 500 inclusion, the force buying. So if we're talking super short term, we're going higher. But after that, what needs to happen? So I said, Alex Karp and the team will need to continue to come through with huge growth rates to keep the momentum going past the S&P 500 inclusion. If growth falls off in any way, then the stock will get stuck in the $28 to $38 range for many years. not many months, not many weeks, for many years. If Palantir can start growing 30% plus revenue, along with massive earnings per share expansion, then the company could climb to $50 plus in the next 12 to 24 months. So that's the thing. That's the only way Palantir keeps this momentum going after this inclusion happens. You got all the hype, you got all the excitement, you got the FOMO in the market right now around Palantir. It's great for the short-term stock price to go higher. It's got all the ingredients for higher in the short term. But in order for the stock after this year to continue the momentum and continue going up, right, we've got to come through with epic growth rates, much higher than what we've been coming through with. You can't just get away with doing what you've been doing, the 20% type revenue growth. We have to take it to another leg higher in 2025. I'm talking 30% plus. When I talk about earnings per share, I'm talking that's got to increase way faster than 30% plus. And that could keep the momentum going, and that's how you could see Palantir get to $50 plus, and not only get to $50 plus, but stay $50 plus. And then we're not talking about gamma squeezing, we're talking about fundamentals of the company and people feeling good about buying Palantir stock at $50 a share. Not because they believe it's going up in the short term because of XYZ reason, but because they believe it's going to be a $100 stock, a $200 stock, a $300 stock. That's what has to happen to keep the momentum going after that. If we can do that, if Karp and the team can do that, we'll keep this momentum going after S&P 500 inclusion. And then you'll see the stock all of a sudden 50, 55, and we'll go up from there. But that's what needs to happen, right? Now, here's a problem in regards to Palantir stock. We got another problem, right? If you're buying Palantir stock right now, you feel like you're buying on FOMO. I'm just going to call it what it is, right? You feel weird if you're an educated buyer. Like if you're brand new to the stock market, you don't even know what FOMO is. You're like, fear of missing out. I don't know what that is. I don't know. If you're educated, you kind of feel awkward and a little weird because there's so much hype and excitement around Palantir, the SP 500 inclusion, right? I mean, my gosh, you kind of feel a little awkward buying it, right? But on the flip side, if you like Palantir and you don't buy it right now, right? It feels like you're making that decision based upon hope. And you never want to feel you're making any investment decision based upon hope. Because at the end of the day, you might look at this and you might say, I hope, the stock's 33, 34. I hope it goes back under 30 again, right? Not a position you really want to be in. You never want to make your buying and selling decisions based upon hope. If your hope in the market, you're in trouble, right? So what do you do in this sort of situation? What do you do if you're an investor in the market? Here's exactly what you do, okay? You don't feel FOMO. You don't feel like you got to not buy because of hope. Here's what you do, okay? Go to 1000xstocks.com. If you have access to it, great. If you don't have access to it, apply for access to it, okay? Once you go to 1000xstocks.com, go to specifically the valuation tool, okay? The valuation tool once you're on 1000xstocks.com. From there, type in Palantir's ticker symbol, okay? Now, what I want you to do is think about what do you think Palantir's revenue growth rate will be on average for the next many years? Knowing the AIPs in the market, knowing how much excitement's around the business model, what the potential could be there, potentially raising price, government contracts, everything that's going on there, what's going on with Apollo, Gotham, right? Foundry product, what you think might come out for future products in the next few years. What is the revenue growth you expect? Is it 20% on average? Is it 25%? Is it 30%? Is it 35%? Do you think they're going to get up to a number where they're doing like 40%, 50%, and like the revenue growth is going to really take off 2025 and beyond? Where do you think? Go ahead and plug those numbers in there, okay, on what you think the average is. Then go ahead, go down the net income growth line. Palantir should grow their earnings per share much more rapidly than their revenue, right? So then go ahead and run projections on what do you think Palantir's net income growth will be on average per year for the next years, okay? From there, run what you think are fair PE ratios for Palantir. Now, if you expect the company to grow, let's call it their revenues and net income 2x the average stock in the market, well, keep in mind the market grows, the market PE ratios are usually around 20 roughly. So then you should probably command a 2x valuation higher than an average stock. So if the average is 20, then you might want to think about like a 40 PE ratio, right? If you think 3x, if you think Palantir's revenue growth and earnings per share growth is going to be over 3x, right? The average stock in the market, then you have to kind of run your PE ratios like 3x, the higher than 20, right? Which would be like a 60. If it's 4x growth rates, then you could run it at a 4x number, right? Assuming you think that that is a sustainable growth rate over the coming years. Then if you, let's say it's 50% higher. Well, if average P is at about, a 20, then you're going to run your numbers at about a 30 P, right? Because you're about 50% higher. Run those numbers, and then you're going to get what your share price should be 2027, 2028, right? And what the compounding annual growth rate is. That's when you can begin to understand if Palantir is a buy today or not a buy today, based upon the numbers and projections you're running there. That's how you actually make investment decisions, not based upon feeling or I like the company, I think they might do good. No, you got to run the numbers. And if the numbers check out and you say this is going to give me a compounding annual growth rate of 10%, 15%, 20%, 25%, Palantir is a buy today, even if it feels FOMO-y, right? If you run your numbers and let's say you got 20% revenue growth rate and a 25% net income growth rate, right? And let's say, you got your PEs at a 40 to 60, and let's say, the compounding annual growth rate is roughly in line with the S&P 500, then, maybe it's not a buy for you, or if it's lower than that, right? But if your compounding annual growth rates here, 2027, 2028 is what you specifically want to count on, if it looks very attractive based upon your numbers, it checks out as a buy today. That's what you got to understand, okay? It's about valuation. The way I kind of put it to you like this, right? Let's say you're going to play poker. Without 1000xstocks.com, you're basically like a clueless player who's like just throwing money around. Like, I don't know what I'm doing. Like, I don't know what the hands are. I don't know the probabilities and things like that, right? Viewing it through a valuation lens, you kind of like with 1000x, right? It takes you to Phil Ivey. And all of a sudden, you know what all the probabilities are here. You know what's likely to play out. You know the risk involved, right, with making certain decisions. And then you can actually make an educated, fundamental decision rather than just feeling like you're gambling money around. Because if you don't run the numbers, you're gambling money. You got to understand that. If you can't project out what you think a company's revenues are likely to do over the next 3, 4, 5 years, as well as their net income, you're not making an investment decision. You're making a gambling decision. You have to make investment decisions out there. Every time I go to buy a stock, I make an investment decision. It does not mean I'll be right 100% of the time, but it means I'm actually making an investment decision, not a gambling decision, okay? And that's how you take yourself out of this mindset of like feeling like you got to buy on FOMO or feeling like you're going to hope the stock goes lower and start putting yourself in a position, you're the Phil Ivey at the table and you know exactly what's going on here. And you're able to say, this is a steal deal. I'm buying shares at 33. Or you're able to say, no, this isn't the one. Like the growth rates I'm getting here is not attractive enough, right? That's how you take it up to a higher level, right? That's making investment decisions. Now, speaking about investment decisions that have done very well the past 5 or 6 years, Elf Beauty is among the best of the best, right? This is a best of breed stock. This is, if you're a Palantir shareholder, you want your company to do what Elf has done over the past 5, 6 years. Elf's had accelerating growth rates. They've become an insanely successful company, by far and away the most successful company in the cosmetic space really in the past 5 or 6 years, and just kind of came out of nowhere, right? You want Palantir to do what Elf has done. So then you can sit on 1,500% gains, right? So what's going on with this stock? Is it a buy now? So stock is down 42%, almost 43% in the past 6 months. Incredible, right? And you got to say, why? Elf's numbers have been so good. Like, why is the stock just getting clobbered? What is going on here, right? Well, we're at a very tough stage for Elf. And when I say tough stage, I got to explain that better, because you have certain tough stages with a company where, let's say you think a company, or let's say a company's going through a tough stage where it's like people are worried if they're going to make it, right? Like, are they going to go bankrupt or something? That's a level of a tough stage. Elf is going through a different tough stage right now. Their tough stage they're going through is what's called deceleration in revenue growth. So if you look here, Elf on a shelf was on fire for years. Look at this. Quarter after quarter, their growth rates just went higher. 10%, 13%, 26%, 33%, 49%. Then they were kind of kind of in that 76 to 78% growth. Then they exploded all the way up to the blow-off top number here, 84% revenue growth, right? And that's when the stock went to $200+ a share after that quarter came out. Since then, 71% revenue growth, 49.9% revenue growth. People are talking about maybe under 40% for the next quarter, right? And you got to keep in mind these comps are going to get tougher and tougher as these quarters go on. So we're at a tough stage for Elf right now where it's the growth scare stage. This is a stage that it's still amazing. Like, even if, let's say, Elf grows next quarter, let's say they grow 38% revenues. I mean, how many other companies in the market are growing revenue 38%? A very small amount of companies are growing revenue 38%, just assuming that was the next quarter numbers, right? Even if they grew horrible for ELF, 28% next quarter. I can tell you almost every other company out there would take 28% revenue growth in this market like that. Like, give me that revenue growth. But for a stock, it's a tough stage to go through because you got to understand, for stocks to usually go through a major upcycle in regards to stock price, usually you get accelerating revenue growth, not meaning the revenue is going up. That's how good companies should operate, revenue going up. We're talking about the growth rate increasing. So you went from growing 10% to now 12%, to 15%, to 20%, right? Revenue growth accelerating. Earnings per share growth accelerating. Margins accelerating upward. People are worried about ELF in regards to not the company in general, but just worried about deceleration. Earnings per share growth, they're worried about that decelerating. I think earnings per share growth is going to come through very, very nicely 2025 and beyond. This year, they're not really focused on earnings per share growth. So I think anybody viewing the earnings per share growth is misguided in regards to this one. But the revenue growth, there's no debating. The numbers are decelerating, right? It's still growing insanely strong and insanely fast, but it is growth rates that are decelerating, which investors don't like to see, right? Margins are, we'll see, right? People are worried about the growth rates there decelerating as well, which sets up the stock to go through kind of a tough time there, right? Now, here's the deal, okay? If you look at what numbers are projected by analysts here for this year and next year, as far as earnings per share, not very much there. As far as revenue goes, 29% revenue growth expected this year, only 18% next year, which, to be quite honest, those are low numbers, guys. For ELF, these are actually really bad numbers. ELF is a company that's been growing revenues, I just showed you, 70+%, right? I mean, look at this. 78%, 76%, 76%, 84%. I mean, even if you look at the last, 6 quarters here, 1, 2, 3, 4, 5, 6, 7, the last 7 quarters, the weakest growth rate in the last 7 quarters was 49.3%. But now, right, now we're talking about revenue growth significantly lower than that, right? We're talking about 18%. 18%. So, that's a major deceleration there. Now, here's the deal, okay? ELF could be setting up for an absolutely epic, massive upside in 2025 and 2026, where the stock goes back to new all-time highs. And we're talking about breaks 212 or whatever the old all-time high was. I can't remember if it was 212 or 220. And it breaks out above to those new all-time highs. And here's the reason, okay? Analysts have those projections. Those projections, my hunch is they're probably way too low in regards to ELF. ELF's probably going to smash these numbers, right? As they've done quarter in and quarter out for years now. Quarter in and quarter out for the last many years, they've blown analyst projections out of the water. My guess is analysts are too low with their projections. ELF's going to come in next year and smash their projections, and you could have a situation where the stock's in a very lower range, and the stock's going to move up huge because of the smashing of that, right? And you already had a lot of people have moved out of the stock because it wasn't the momentum name anymore at that particular time, right? And so when I look at ELF's expansion international, when I look at their expansion into retailers they're already in but getting more shelf space, their sell-through is ridiculous. And if you're a retailer, you got to understand, you have a certain amount of square footage, right? You have a certain amount of square footage for your cosmetics area. I don't care if you're Walmart, your Target, Walgreens, CVS, whoever sells cosmetics, okay? Ulta, right? Sephora, everybody's got a finite amount of space in that store. As a retailer, what's the number one thing you need to do? You need to have products that bring in customers and that move. If you have somebody's product over here and it never moves, right? No one buys it. It's a wasted space as a retailer. You need to have the best-selling stuff. We know ELF sells ridiculously well. So it makes sense if ELF is selling so strong and bringing in customers to your store, you need to give and allocate ELF more and more space, right? It's just like business 101 when it comes to retail. So this sets ELF up in a pretty good position to continue to expand shelf space in 25 and 26. They're going to continue to expand international, and if there's any retailers that don't have them, which there's still a few, they're going to get into those retailers over the next couple of years. Now, additionally, here's my base case for ELF, and here's where I think ELF stock is going over the next few years, okay? My base case for ELF, I have them growing revenue 25% a year on average from 2025 to 2028. Now, that's incredibly slow compared to how they've been growing revenue. They've been, like I said, the last 7 quarters, the worst growth rate they had was 49%. So we're talking this is like half of their worst growth rate in the past 7 quarters, right? 25% I have them doing there, which should put the company in 2028 a little under $3 billion of revenue, okay? Now keep in mind, ELF's around a $6-7 billion market cap right now. Net income-wise, I have them accelerating that to about 35% a year on average, 2025 through 2028, right? Which puts them at a net income margin of only 12%. That's not a high net income margin. ELF's gross margins are have approached like an 80% level now at this point in time. It's ridiculous, right? 70, 80%. And so net income margins of 12%, not very good. I think my base case is pretty conservative, my personal opinion, okay? Now, PE-wise, well, here's the deal, okay? If you're growing your revenue on average 25%, you're growing your revenue way more than 2x an average stock in the market, right? Keep in mind, S&P 500 PE ratio, usually around 20, right? Sometimes it's higher than that, sometimes it's lower, but usually the average is around 20 roughly, right? So I'm talking about growth rates here that are way above 2x. It's more like a 3x or a 4x of an average stock out there in terms of revenue and earnings per share growth, right? And so I have them about 2x the market in general, and here's about, we can call it about 3.5x here. So a 40 to 70 is pretty realistic for a consumption business model like this. It's almost like a SaaS business model. Like if somebody keeps buying ELF Foundation, they're going to keep buying ELF Foundation or Primer or whatever it is, right? And so 40 to 70 is about right if they can grow at these sorts of rates, which I think are probably conservative, which puts the stock in 2028 at somewhere between $259 and $453, which gives you a compounded annual growth rate on the low side of about 23%, on the high side of about 41%. I'll take that. And so ELF has actually emerged as a buy. ELF's a buy. ELF's a buy today. It doesn't mean if you buy ELF at 113, doesn't mean expect it to go up over the next, 2 months. But is ELF a buy from a longer term perspective? Based upon my numbers and projections on just my base case, yeah. Keep in mind my base case has 12% net income margins. 12% in 2028, when ELF's a way more mature business model, 12%, that's bad. I went pretty darn conservative. And even with my conservative numbers, the CAGR is insane. Compound annual growth rate is ridiculous in this one. So the moral of the story is ELF has actually emerged as a buy. Now, you could get some tax loss harvesting that comes into the stock in the fourth quarter. Completely possible. But I'll say for the remainder of this year, any major dips in the stock, buying opportunity. For long-term investors. If you're just playing it for the next 3 months, you might be in trouble. But for the next 3 years, 5 years, the math looks pretty darn appetizing here, right? Keep in mind, as ELF does expand more and continues to obviously expand their earnings per share, I mean, my gosh, they're gonna put themselves in a situation where they could do share buybacks. They could buy out other cosmetics brands, which they obviously bought Naturium last year, right? That's a huge growth vector for the company. ELF might emerge as an Estee Lauder type company in terms of they own many successful brands. As of right now, when I look at ELF, I really see 2 super successful brands. ELF and Naturium, right? And Naturium's got the way more growth ahead, in my opinion, over the next 5 years. But could they own 5 or 10 super strong brands 10 years from now? I think that's a potential. And so just keep that in mind. But like I told you guys before, there's one thing I'm concerned about with ELF. There's only one thing I'm concerned about ELF long term. I am concerned that Estee Lauder might try to hire Terrain. If I was Estee Lauder's board of directors, I would throw everything at Terrain. Give him the most money. Give him the most stock options. Tell him he's going to make so much money, it doesn't matter if ELF stock even 10x'd over the next 10 years. Even if that happened, he's going to make way more money from Estee Lauder. I would throw everything at him. And that's the one thing I'm scared at, because he is the hottest CEO in the cosmetics industry by a mile. And so that's the only thing that really concerns me long-term with ELF, is that if he got stolen away. But he has put in place the DNA at ELF that if he did get stolen away, I think we're okay here. And by the way, don't be surprised at all. The day Estee Lauder new CEO is announced, if it's not Terang, don't be surprised if ELF stock explodes higher that day. Don't be surprised at all. So just a little food for thought in regards to that. We'll see. And I don't know what he'll choose, but I'm telling you, like, my thought is, I bet you Estee Lauder's trying to get him hard. Monster and Celsius. So these stocks up big here today. Is the bottom in finally for these stocks? Celsius literally seems like Celsius goes down every freaking day. Does it not? Like basically for the past, 6 months or so, it seems like every day you wake up and you go look at Celsius stock price, it's red. It's unbelievable, right? Finally, a nice green day, up 5% or so, right? Now, these are obviously two stocks I bought recently. Monster started a small position there, Celsius as well. So these are new positions in the public count. So here's the deal, okay? People are starting to look at Celsius as a value play. It's a huge changing of the guard in regards to Celsius stock price. Celsius stock price 6 months ago and before was a growth investor stock. 5 years ago, let me back it up. 5 years ago, Celsius was a speculative stock. It was a spec buy. If you bought Celsius stock 5 years ago, you're super rich now, by the way. But additionally, you were buying Celsius because it was a spec stock. It was speculative. It was like, maybe this company could become an energy drink giant someday. And they actually did it. Like, who would have known? And you got rich, right? Good for you. But then you bought it 3 years ago, 2 years ago, even a year ago, even 6 months ago. You were a growth investor. You looked at the valuation that was extremely high and you said, I don't care. The growth rates are ridiculous. This company is going to keep growing and I'm going to buy because I'm a growth investor and I love the growth. Well, growth has been tough to come by here recently and it looks like it's going to be tougher to come by for the next at least couple quarters here, right? Which means if you're a growth investor, you're looking at Celsius and you're not as attracted to the stock because you're like, they might grow single digits a quarter or two from now. Like, do I really want to be in Celsius? But the stock falls so much, right? Stock goes down. I mean, it was up to nearly $100 at the peak earlier this year. Now it's down to 30 something. The stock's fallen 60, 70%. And also the value investors wake up and they say, hey, what's going on here with the Celsius company? Oh, you're talking about they might still grow 10%, 15% a year? And the PE ratio is what? Oh, that actually looks kind of interesting. Like, I think I might take a risk here. Oh, guess who bought Celsius recently? And I would look at myself as kind of a combo of growth, value, and dividend investor. I look at all three brackets and, but at the end of the day, my core always goes back to the value. I would say that, right? As somebody that kind of learned from like Warren Buffett strategies, my core has always gone back to value. So even if I buy a growth company, I got to be able to run projections that the stock is still going to be a steal deal based upon what I think their net income is going to go to over the next 3 years, 5 years, those sorts of things, right? So now we have these value investors starting, the keyword is starting, to want to step in with Celsius, right? This came out of Barron's, I guess, over the weekend. Celsius Holdings gets the Barron's nod as an undervalued play, right? Celsius Holdings was signaled out by Barron's as a stock that has been oversold due to concerns about slowing growth trends. And so all of a sudden you have these value investors that say, you know what, I'm interested in this one. Now, that being said, have we reached a bottom on the stock? Hold on. Hold your horses for just a moment, okay? We still got a lot of tax loss harvesting coming in the fourth quarter. It's coming, man. It's coming. I have low trust on any Celsius balances until 2025. Listen, the six month chart in the stock's down 61%. You got to understand, everybody that's bought the stock for the last year or two has lost money. They've lost money in the stock. They're down big. Every fund that's bought the stock, every retail investor that's bought the stock, they've all lost a fortune in the past 1 to 2 years. The 5-year people have made a fortune. They got rich, right? People are buying the stock 5, 6 years ago, they got stupid rich. The people that ultimately have been buying it recently, as in the last year or two, they've lost a lot of money. They're down big. And you're going to get a lot of those people in the fourth quarter this year that say, I'm going to sell this one for a loss, and maybe I'll buy it back in the future, maybe I won't, right? But write that off against gains. And you're going to have a lot of that. And you've got to understand that. So that's still coming, right? No, in between this time between now and, that tax loss harvesting, could the stock also go to make a run to 40 and then fall right back down to the low 30s when the tax loss harvesting comes? That's a potential as well. So do keep that in mind. You could all of a sudden have a big uptrend for a few weeks and all of a sudden just another massive downtrend in Q4. We'll see how it all plays out. I've seen that happen many times. But I have low trust in any bounces in regards to Celsius until next year, okay, until we get through tax loss harvesting. Now, Nike showing weakness, obviously, in regards to stock. Could this stock head back to $72, back to where it was, let's call it in the middle of the summer? Well, here's the deal, okay? The earnings are coming out on October 1st. So that's about, 3-4 weeks from now? Could the stock go back down to 72 or even below? Yes, it could. But what needs to happen in order to do that, and by the way, I hope this happens. I really do, because Nike is just a company I want to hold for the long term, so I would love it to go down under 72. But they would have to come out with a triple miss. They'd have to miss revenue, miss earnings per share, miss guidance. If they do that, we can go right back down there or below. And I hope that happens. I really, really, truly do. Nike is not a stock, even though it's a stock I've already been buying, it's not a stock I'm rooting for to go up in the short term because my position's not built in Nike yet. It's been building, but it's not fully built. Like, I want to buy Nike for at least the next 3 to 6 months. So the bottom line is I have a finite amount of money I can buy with, as every other human on this planet does, right? So I want as many shares for as cheap as possible. So if you told me, would I want Nike today at 75 or 55? 55. Give it to me for $5. Like, I want it as cheap as it can go, right? And keep in mind, this is a stock that will face tax loss harvesting as well in Q4. Listen, man, everybody that's bought Nike stock for the past several years lost money, right? So you think that the stock's not going to face some tax loss harvesting in the fourth quarter? Of course it is, right? Of course it is. But the thing is with the Nike, if the earnings came out really good, could the stock blast higher to the $85 and then tax loss harvesting comes and it goes down to 80 or where it's at now, 79, 78? That's a possibility as well. But I can tell you, they triple miss, we're going right back down to 72 or below, which I hope happens. Now, Apple, here's the deal. I watched that whole live event. Do I feel like, did I walk away excited as an Apple customer from that full event? So here's the deal. Okay, here's what they launched for products. This is the big dog, right? iPhone 16 Pro. This is their main product, in my personal opinion, for the company, right? I think this 6.9-inch display is going to do very well for the company. Very, very well. I think the lead times are going to be insane on this. It's the biggest iPhone ever. Anytime they launch the biggest iPhone ever, it sells phenomenal. The lower tier iPhone, the regular iPhone, right? That one's going to be 6.7 inches. So if you want the true biggest iPhone ever, you have no choice than to bring out your pocketbook and spend, I don't know, $1,500 or whatever it's going to be on the Big Daddy. So I think this is going to sell ridiculously well. Like, ridiculously well for the people that have money. The problem is not everybody can afford this $1,500 phone or whatever it's going to be, right? Certain memory storage, you might end up spending $2,000 plus. So I think there's going to be an epic wait time on this phone. The other phones, I'm going to be honest with you guys, put me to sleep. Put me to sleep. This is not a super cycle for the lower end phones. I want to be really crystal clear about that. Next year's a potential based upon kind of what I've heard and seen from next year's cycle. Next year could be a super cycle for the entire iPhone segment. This year, it's going to be a super cycle for the top end because of that 6.9-inch version. I think anybody that's got a lot of money and loves iPhone, they're going to buy that phone. And I think you're going to be looking at some of the longest wait times in Apple's history for that highest end iPhone. I hope they better be producing those like left and right already, because I'm telling you, if I was at Apple, I would increase those units dramatically versus last year for the top end iPhone. But those other ones, I didn't see the feature set. I didn't see the design that really makes the lower end ones, the people that buy the $700, $800, $900 type phones, right? I didn't see it from there that made those folks say, dang, I got to go get the new iPhone. I think that might be next year, though. So just a little something to keep in mind. And this iPhone, usually the margins are very attractive. So that is going to be good for margins for likely Apple. ASPs for Apple as well, and profitability. Now, additionally, they showed off AirPods Pro 2, which has health features, including clinical grade hearing aid. Now, here's the deal, okay? This isn't something that's going to make a 17-year-old go out there and say, dang, man, they're new freaking AirPod Pro 2, bro. You got to go get these. Oh, yeah. No. But I think this is much more important than it seems. And the reason being is Apple, the more I view it, is starting to become a healthcare company. And I've kind of been thinking about this last few years. It's ultimately one of the most interesting, if you're interested in playing healthcare sector at all, I would buy Apple stock. I'm not kidding you. If I really wanted exposure to healthcare, I'd buy Apple stock. When I look at the tech they're starting to include in the Apple Watches over the past few years, when I look at kind of what they're up to here with AirPods, kind of creating those and making those into like hearing aids, the more I'm looking at this overall, the more I'm starting to view Apple as overall a healthcare company. And so healthcare companies usually command pretty good valuations. It's a services company with a healthcare component, right? So I think that makes it pretty darn attractive. I got to be honest with you in terms of if you're looking for a healthcare play, right? Now they also announced these AirPods 4, which are going to be priced at, I believe, $129. These should do phenomenal. The most comfortable AirPods ever, they called them. Yeah, those will sell very good. They're AirPods, they always sell good, the new generations, right? They also showed off some new Apple Watch models, which once again have a lot of different health features included. They have the new Apple Watch Series 10 that's going to include new health features for sleep apnea, which I guess supposedly they say affects around 1 billion people worldwide. So I think that's big as well, right? And so I came up with a new slogan for Apple. I said, Apple, the healthcare company. We're Apple, the healthcare company, right? Yeah, I think the products are good, but was there anything in there that made me say, oh my gosh, like, you know, is there anything here that's going to make the high school kid and the college kid and the person that, you know, is in their 20s to say, oh my gosh, this is epic, man, this is crazy, go out and get this? I don't think so. I think this was more of one of those things. I think this is one of the more of those releases that maybe the older crowd are going to look at these things. Like, I think this iPhone's going to sell ridiculously well, right? I think if you have hearing problems, you're going to be looking at the AirPods Pro 2 and you're like, that looks like a dandy product there. I think I'm going to get a pair of those, right? So just got to understand kind of what's going on there. Okay, guys, appreciate you joining me as always. Thank you so much for being here. Pin comment down there today. My brand new workshop recorded for you guys a few days ago. Stocks to buy now for 2025 and beyond, as well as how to position your portfolio for next year. All those sorts of things. Get access to that will be pinned comment down there. Much love and have a great day.